Crisis returns to Wall Street as America loses its top credit rating and markets around the world swoon. Investors find themselves at the edge of disaster once again.
No one can say where the bottom is going to be.
That downgrade was a political downgrade. It wasn't a business or an economic downgrade.
Unless they get their act together, the U.S. is on a secular decline, and the standing of the U.S. is going to go down.
As the president fights for his country's stature, the world holds its breath and hopes for the best.
No matter what some agency may say, we've always been and always will be a AAA country.
From Bloomberg World Headquarters in New York, this is Downgrade, a special report with hosts Lisa Murphy and Adam Johnson.
Well, good evening, everyone. Today we saw the impact of the U.S. credit downgrade from Friday night. Not pretty, Lisa.
Not pretty at all. The Dow and the S&P saw their biggest sell-off since 2008, $2.5 trillion erased from global equities. Well, the downgrade of U.S. AAA credit rating feeling a lot like a downgrade of the United States' reputation in the world.
Well, and to help us sort it all out tonight, we have a full lineup, beginning with hedge fund manager Orin Kramer. He's run money for the state of New Jersey. Now he runs money for Boston Provident. The always outspoken Congressman Ron Paul of Texas on Washington's blame game. There's plenty of that to go around. And Bethany McLean, who wrote the book on the financial crisis, quite literally. And she has a few things to say about the rating agencies.
She certainly does. We talked to her early this morning, and she has more thoughts to add to that.
Oh, I'm sure.
All right, Adam, let's take a look at markets opening up overseas. Asian markets, once again, we see the bottoming out continuing. You can see right there the Kospi now down 5%. Australian stocks also getting hit hard at the moment, down about 5%. And New Zealand also down. Now, these Sydney, by the way, Australia and New Zealand, both AAA rated countries. You can see, though, their stocks not a safe haven by most investor concerns. Let's take a look now at the Nikkei. That is down 4%. The Hang Seng down 2%. Adam, I want you to walk us through some of the other dramatic moves we saw in today's trading session.
Okay, well, I'll tell you something. A lot of these charts look very similar, and they're not pretty, Lisa. Starting with the S&P 500, down 6.6%. Look at that. It just slid straight through the day. That's the S&P, and guess what? Here's the Dow sliding throughout the whole day, down 5.5%. The Nasdaq sliding down all day, down 6.9%. And guess what? It's not just the U.S. Let me show you Brazil. Brazil's supposed to be one of the exciting commodity places to invest. Look at that, down 8%. It's now down over 20% on the year. Here's another one for you, Lisa. Look at this. Germany, the DAX, down 5.2%. In other words, the devastation was not just in the U.S. It was just rippling through. And unfortunately, it's not that it's just today that was bad. It's actually what's been happening since July 22nd. Take a look at the sea of red. All right, we're looking at the worst groups since July 22nd. Energy and financials both down 21%. That would be a bear market, Lisa, over 20%. Materials down 20%. Industrials down 19.8%. Again, these are the declines just since July 22nd. So as bad as today was, unfortunately, Lisa, today was just a continuation of what we have been seeing for several weeks.
All right. Thanks so much, Adam, for recapping the day's events. Well, for more on today's sell-off here in the U.S., which erased about $2.5 trillion in equities worldwide, we turn to hedge fund manager Orin Kramer. Kramer's the general partner of Boston Provident, which manages investment vehicles focusing on the financial services industry. He's also the former chair of the New Jersey State Investment Council. Welcome, Orin, here to our special this evening.
Thank you.
Let me ask you, first of all, when Adam and I, we were both down on the floor when the opening bell rang, we really saw the oil and gas sector getting hit hard, but by the end of the day, financial services, no matter what index you were looking at, really led the way down to the bottom. What did you see in your portfolio, and were you shocked?
Well, first of all, I run basically a financial services portfolio, so I saw a lot of red.
And were you surprised at how much relentless red? But there was such an acceleration, right? When
it was
we heard
actually,
the
by the way,
speak.
today was the first day that this is not about financials, but the S&P 500, all 500 companies were down.
Yeah, that's a great point. Every single name, even Newmont Gold, right? I mean, you would think if one name's going to be up, it might be a gold miner. Not today.
Right. We took a look, actually, 144 stocks in the S&P 500 hit a 52-week low, but I want to get back to financials. Clearly, when the president came out and spoke, we saw a definitive move in the market lower, and then that acceleration just headed right into the closing bell. Why did financials take it so hard?
Well, first of all, financials are down 20% since the end of the latter part of July. And I think probably the biggest part of that actually is about Europe. and fear about spillover effects because they do live 2 steps behind the curve over there. So that's a problem.
Well, plus some of the European paper also lives on U.S. bank balance sheets.
Well, there's some of that. And look, the problem when you have any kind of a leveraged company is, you saw it with Bank of America, where they did the 2 worst deals actually in the last 20 years. When you have a leveraged company, management is important. And obviously, if you're looking at a company that's leveraged, say, 14 to 1, you don't know in a complex bank what might be on those balance sheets. Having said that, I think it's mostly, it wasn't actually about that piece wasn't about the downgrade per se. It certainly wasn't about the president. It was about...
Do you think that's about Brian Moynihan? Because every stock today, every financial stock, had a bad day.
That's correct. I don't want to pick on Brian Moynihan. He had a worse day than most people had today. I mean, at one point, I think Bank of America was down 20%, and there are questions about Bank of America having to raise capital. Actually, if you look at the banks, there's all this talk about 2008, but they are much better capitalized. They are much better reserved. They are much more liquid. I mean, if you take J.P. Morgan, Citi, 35% of their assets are liquid. It was 27% in 2007. They have much less exposure to levered assets. It isn't quite the same picture.
So in other words, they're getting cheap. They might be a buy. Perhaps it's something you take a look at.
I think Citi probably, there's the greatest level of fear relative to the merits, but yeah.
We got to leave it there, unfortunately. Orin Kramer joining us, talking today about the bank stocks getting especially hit hard. And we didn't get to talk about credit default swaps, but those really rose quite dramatically on the day as well on the banks.
Well, I'll tell you, one place that didn't show pain, gold and U.S. Treasuries, they are about the only places to hide. We will explain, believe it or not, why that might actually be good for Wall Street. We are back in 2.
This is just a massive, massive flight to quality that has been happening over the last week and a half. And it seems like treasuries are still the best flight to quality asset out there, regardless of what a rating agency says.
Well, welcome back to Downgrade, a special report. It was the closest thing we have to a referendum on S&P's decision, and bond investors gave it a resounding thumbs down. Economics editor Michael McKee is here with a look at the bond market's dramatic rally. People buying bonds in spite of a downgrade.
Well, a downgrade is supposed to raise the cost of bonds because it adds a risk premium. But from investors' actions today, you'd have to see
not so much.
They still see treasuries as risk-free. Take a look at this. I mean, 2-year yields hit a record low today. 10 years are the lowest since January of 2009, the height of the financial crisis. And we're trading again. They're still going down. How manic was the rush into treasuries? Well, by some measures, investors investors are willing to lose money to get them. For a time, 1-month bills were trading at a negative yield. Willing to lose money at that point. And take a look at this, both of you guys. 10-year note yields, the white line, a common measure of inflation expectations, the orange line, 5-year forwards, 5 years from now, it shows real interest rates are negative. Bond investors are going to lose money on these investments if they're to hold them. Now, the good news is, obviously, there was no forced selling today, obviously, and the system worked, no hiccups.
Well, there's nothing else to invest in, though, Mike, right? I mean, AAA corporate paper is fairly limited, particularly on the shorter end, right? There's not too many issues you can put your money in.
A lot of corporations are not going to market because they have a lot of cash on the books, and there's so much volatility right now. Fund managers don't want to misprice an offering, so corporations are sitting on the sidelines.
And the muni bond market, is that a place to turn?
No, at this point, well, muni bonds are doing very well, but everybody was waiting for the S&P downgrades today.
And a couple of those started to come
out
after the close.
Yeah.
All right, what about just ordinary Americans? What about the little guy?
Well, actually, ordinary Americans are doing a little bit better than Wall Street on this deal. If these rates are sustained, ironically, we could all be better off. You don't expect credit card rates to go down because banks are suffering. They make money off your unpaid balances. Helping you is the last thing on their minds. But there's a very good chance mortgage rates are going to drop. Look at this. The coupon rate for 30-year Fannie Mae bonds, they track mortgage rate movements pretty closely. Fannie and Freddie, of course, downgraded also by S&P today. Another case where the interests of Wall Street and Main Street diverged, though, because the difference between Fannie Mae note yields and Treasuries widened, even though both yields fell. Analysts say it reflects increased volatility because with rates low, people may refinance, and that means the people who hold those notes are going to be losers. And among the losers, the Federal Reserve, because they have $112 billion in agency bonds that they bought during QE1.
Wow.
It's hard to keep track of this money trail, Mike, but you're so good at connecting the dots. The question is, I guess, there's a lot of prepayments that are expected. I don't know that homeowners are going to be able to refi, right? That's the next big story.
That's exactly right. You can't necessarily make the credit, or you can't put forth the information you have to.
The bank has to let you refi. All right. Thanks so much, economics editor Mike McKee joining us. Well, coming up next, the rating agencies have been widely criticized for missing the mortgage meltdown. So how much credibility should they be given now? We're going to get some insight from Bethany McLean. She's co-author of the Enron expose, The Smartest Guys in the Room. She's also a Bloomberg contributing editor. Well, that's coming up after the break on Downgrade, a special report.
The markets, on the other hand, continue to believe our credit status is AAA. In fact, Warren Buffett, who knows a thing or two about good investments, said if there were a quadruple A rating, I'd give the United States that.
Okay, ironic is one way to describe it. The president citing Warren Buffett's faith in the U.S. just an hour or so after S&P lowered its outlook on Berkshire Hathaway to negative. Well, the agency said Berkshire is too reliant on America's creditworthiness. Another casualty of America's debt downgrade, Fannie Mae and Freddie Mac. S&P downgraded the housing giants to AA. Plus, because of their, quote, direct reliance on the U.S. government. S&P also downgraded 10 federal home loan banks. Well, my next guest says there's a silver lining to all of this. It's yet another wake-up call that something needs to be done about the political process and America's fiscal problems. Bethany McLean is a Bloomberg contributing editor and co-author of All the Devils Are Here, The Hidden History of the Financial Crisis. A financial journalist, she got her start as an analyst at Goldman Sachs. Bethany, good to see you again. Adam and I saw you bright and early this morning, and Mike was just joking. You're going to write a new book called The Dumbest Guys in the Room.
Because and we hope we're not in that.
We hope we're not in that. I hope not. But, a lot of people accusing S&P of making a grave mistake with the downgrade on Friday.
Right. I think they made a grave mistake, too, not necessarily in their conclusion, but in the process in which they used to get there, because there doesn't seem like there's a strong intellectual underpinning to the process. And so you look at the wizard behind the curtain, and he seems like he's an angry American kind of sitting there in his armchair opining on what politicians are going to do. And you think, is that it?
But if, in fact, the political process is unable to come with legitimate fiscal policy, then it really does matter.
Right, and I think it does matter. I'm not saying that S&P arrived at the wrong answer. I think there are a lot of independent people out there who are saying we've got a problem, and we need to cope with it. And there is some silver lining that historically countries that have been downgraded have gotten their debt and their house in order. Canada's a great example of that. So maybe there's but it takes years and years.
And is that what we saw today manifesting itself in the stock sell-off? That this notion that this is not a 6-month, we're not going to solve this in 6 months. It may take 5, it may take 10 years.
Right. I think the stock sell-off has more to do with global financial problems than it does with the downgrade, and the downgrade is one piece of that. But I think the situation in Europe is terrifying. Some of the rhetoric coming from China about our downgrade is pretty terrifying, and some of just the how we reprice assets in a world where there's no risk-free assets, where there's no risk-free instrument. It's a really interesting question. So it's introduced this new note of uncertainty into an already very scary world.
Well, let me ask you, Bethany, just in about 30 seconds to go here, AAA ratings are tough to come by. There are only 13 states in the U.S. that have it. There are only 4 companies here in the U.S. that have it. Is it possible that the U.S. simply didn't deserve it in the first place because of our fiscal situation?
I think that's pretty likely. You look at Mary Meeker did a really interesting piece on the U.S. In Bloomberg Business Week early this year, and you look at a lot of serious analysis. And I think I'm not sure we did deserve our AAA. So I'm not quibbling with where S&P got. I'm just quibbling with the process they used to get there.
What do you think this does to sort of the American psyche and American confidence in the country, and what is happening in D.C.?
I think it's all unequivocally bad, and it's really hard to find a silver lining in that. It's a time when the country is desperately looking for some measure of certainty, and all we seem to be getting is more uncertainty introduced and in more political gridlock. You know, the great irony, all the talk about the political process being broken, the response has been even more partisan.
Wow, quite a commentary.
You know what, I want to ask you one quick question on the banks today. I know you know the bank sector very, very well. Were you surprised that they got hit as hard as they did?
No, because I think that has something to do with Europe as well. Well, twofold, right? One is if too big to fail is what's been supporting the stock prices, then if the U.S. is downgraded, then too big to fail isn't quite what it was. But the second thing is just this fear of a European contagion, which would hit, the virus in a modern financial market, the means of transmission is the financial sector.
All right, Bethany, always great to have you with us. Thanks so much. That was Bloomberg contributing editor Bethany McLean.
Well, S&P says one of the main reasons for downgrading the U.S., quote, ineffectiveness and instability in Congress. We have with us the man who made the call. Listen to him.
We think that elected officials across the political spectrum are unable to proactively take measures to put U.S. public finances on a sustainable footing.
Well, my next guest voted no to raising the debt ceiling and says out-of-control spending is to blame for the downgrade. Republican presidential candidate Congressman Ron Paul joins me, and, of course, Lisa, now from Clute, Texas. Congressman, thank you for joining us tonight.
Nice to be with you.
You know, I have to ask you, when you listen to the S&P comments, and as well from John Chambers, the concern is about partisan politics. You are no stranger to partisan politics. Is it possible that some of your politics is, frankly, how we got here in the first place?
Yeah, I think it is, and it is rather strange because at one time S&P was way behind the curve, and now they seem to be a little bit ahead. But I think that we've had a problem for so long, and I trust the markets much more than these agencies to do the grading of the bonds. Matter of fact, it's strange also because there's still a lot of people buying our treasury bills, and in relationship to other currencies, our dollar holds its own. But what I watch and what I think is more significant long term is the relationship of our dollar to gold, because gold is the only thing that really measures long-term the value of a currency. So I think what they're saying in the market today is, no, we're not going to default. We're going to pay our bills, and we're going to pay the treasury bills, and we'll pay the interest. But what they're saying is the money's going to get cheap, prices are going to go up, and we're going to have a lot of inflation. I think that's what the markets are saying. I think that's what our votes said before. And this is what I've predicted all along. There's no way they're going to quit sending the checks out to Social Security recipients or to the bond holders, but they're going to send money out that has a lot less value. And that, to me, is more dangerous. Yes.
I just want to break in here because I think it's agreed. No one thinks that the U.S. would ultimately default on its debt, not even as we approach that August 2nd deadline. However, there are a lot of questions about when we get our country, the economy back on track, when we get our fiscal house in order. And there's really not that many places to go with monetary policy. And I think that was what was manifesting itself in the stock market today.
Yeah, it is true. We'll wait and see what Bernanke says tomorrow. His only tool is printing more money, and now we're back to square one. We're back to where we were when he started the QE2. So, but I think the default is inevitable. It's just a way we default. We've defaulted many times over our history. When you think about how they refused to pay the gold in the 30s and gold in 1971 to foreigners.
I'm sorry, I have to interrupt you. You just said, you say default is inevitable. The United States defaulting is inevitable. Did I hear you right?
Yeah, but you got to understand my definition of default. If I give you $1, you give me $1, and I give you $1 back in a year, and it buys 20 cents. I've defaulted. The government defaults. They've cheated. They've taken 80% of your money. That's the way all governments default. So that when a debt gets this high, and once you borrow more than 40% of your budget, I mean, it can't be sustained. So the tinkering around with budget and pretending they're going to cut, nobody believes that because they're not cuts. They're cuts on proposed increases. And today it was so discouraging because Obama was supposed to be a little bit more reluctant to go to these many wars that were involved. But one thing he did, he made a big emphasis to protect the military-industrial complex. We cannot, back off on that. So the spending is going to continue. The entitlements will continue. The military spending is going to continue. But the dollar is going to lose value against goods and services, and it's already started.
All right, Ron Paul, let me ask you, in less than a minute, it's a tough challenge. In less than a minute, give us 2, maybe 3 bullet points, a plan. What can we do to fix this thing?
Well, you can't do anything unless you let the liquidation occur. We have prevented it in the 30s. The Japanese prevented it. In these last 4 years, we have prevented it. You have to allow the liquidation of debt and the malinvestment. You can't have growth if you're trying to build it on a stash of debt. So there's been no liquidation of debt. So you have to liquidate it one way or the other. But right now, you should allow bankruptcies. No more bailouts. No more printing press money. Let the market work its way out. And then you will get back to square one where you can have growth again. Otherwise, you're just going to delay this for days and weeks and months and years. Who knows? It could be another decade. Look how long Japan's been going through this. They did not liquidate the bad debt. We're not doing it either. We haven't learned a lesson in many, many years.
All right, Representative Ron Paul from Texas, thank you for joining us.